It's time now to check your money with America's money maven, Vicki Brackens. Vicki Brackens is the president of Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. What a week it has been. Vicki Brackens, how are you doing this morning?
I'm doing great, George, this morning, and you're right. Winter is here. I thought we were going to escape that, but it looks like we're not going to do that. But it has been a very, very interesting week. And there were a couple of topics that we put, one that I put a pin in and one that actually blossomed over the last week to 10 days that I think we should probably bring to the forefront on our discussion today. So I'm going to get right to it. I'll save the housekeeping to the end, but it's exciting. So let's not forget that. So the first one was I made a comment and we had a discussion on changing of mindset. And I said we needed to change our mindset from being that of a debtor's mindset to that of a wealth building mindset. And you asked a question. I don't know if you recall what the question was.
I recall because you said we want to focus on move from debt and credit to equity and wealth. That's what you said.
Exactly. Okay.
And my question was, some people use debt and equity to build equity and wealth. And so how do you know what the difference is?
Okay. So you said some people use debt and credit to build equity and wealth.
That's what I said.
And I said, yes, that's true. But I need to put a pin into that because we want to make sure that we have a thorough discussion on there. Page back 2 years. What was our number one goal? To build your net worth. What was the formula for building net worth? Human capital plus assets minus liabilities. Bottom line, assets minus liabilities equals net worth. If we're trying to build wealth, which is the increase of your net worth, we need to distinguish between liabilities that are designed for building assets versus liabilities that are designed for building consumption. And that was the distinction that I was making last week. And I thank you for bringing us back to it because it needed to be clarified. When you, for example, borrow money to build a business, the outcome, not guaranteed, but the outcome objective is to build a business which becomes an asset. So if you're using debt financing to support that business, then that is actually a process moving toward creation of wealth. If you use debt to go for a vacation in Vegas, that is not building an asset. That is a consumption. Whereas on the other hand, that business that we just talked about, if you were going to Vegas to a convention to meet with a vendor or to meet with a supplier who was going to actually do business with you, that debt that you may create is intended to build an asset which will lead to wealth. Remember, George, when we increase assets, we are increasing wealth. When we increase liabilities that are consumption liabilities, those are subtracted from our net worth and decrease our ability to build wealth. So that was the distinction that I was making, is that we need to go from a mindset of debt consumption versus building wealth. And using debt to build wealth is a very laudable, a very applaudable type of structure. If, I always got this if, we are managing our cash flow and our expenditures in order to support that debt in the proper way. All right. Guess what happened?
That settles it. But that settles it, and I think we have an understanding. And so what would be examples then, Vicki, of this? And I'm thinking sometimes real estate.
Sure. Okay, so
increasing
real
value.
estate is going to increase in value. It is a hard asset that goes into your balance sheet, into the bottom line. You get a mortgage in order to support that because you may not have the capital to actually purchase it outright. That is debt that is creating or intended to, as far as its outcome, to create an asset, which is going to go to your bottom line, which is going to increase your wealth, versus
Thank you.
versus other things that we do with our debt, which are more around consumption, and have no possibility of building the bottom line as far as an asset is concerned. Okay. All right. Now, George. Wow. Big things happened last week all over the news. Lots of conversations about something called GameStop. Before I go too far,
right.
This is not a recommendation to buy or sell or to get involved with GameStop. This is really about a conversation around understanding the process that we just went through. And it was
right,
wild.
Because who else? Right. You should have, I mean, when I was thinking about it, I said, oh, I got to get Vicki to help us understand what happened here.
What happened here? Okay. So I'm making a basic assumption that everybody understands that you buy and sell stock on an exchange. We view most of the time when we are buying stock that the purpose is for the stock to increase, and that's how we make money. The reality is that when you look at a trade, the purchase of a stock or the purchase of an option to buy a stock, you can actually make money on both ends of the trade, both up and down. The market itself is designed to create opportunities for the investor to look at their research, to look at the overall aspects of the companies that they are following, and make a decision whether or not this stock is going to increase in value, and so we purchase what's called long, or decrease in value, and we purchase what's called short. So we are basically saying, my prediction is this stock will go down, and because it's going down, I am willing to risk my money, not to cause it to go down, but because it's already in a downward cycle based on my evaluation, and I want to now purchase on the downside in order to create wealth in that end of the market. All right. So you heard the word short squeeze. So there were several hedge funds who specialized, by the way, in this, who decided that there were several stocks on the market that were based on their financials, based on their product line, based on how much revenue they were creating, were now on the downward cycle of their business cycle, and more than likely were going to continue to go down, possibly even to disappear. So they shorted the stock. What they're hoping for is that the price continues to go down. There was what I would call almost like a class action rush.
Right.
Of individuals who were on some of the messaging boards.
Reddit.
Who thought this was who thought this was unfair, that they were making money as the company was losing money. Mm-hmm. And as a counterplay, they decided to purchase shares of GameStop, which anytime you have activity where more and more buyers are purchasing, it's like any marketplace. When more people are buying something, the price increases. As that price increased, it created now a counterplay and a squeeze on those funds, those managers who had shorted the stock, and forced them into buying more in order to protect the bottom end of their portfolios. It's a crazy thing, okay? But here's where I really want to make an emphasis here. If you do not understand day trading and all the action that's associated with this, and think that it is simply just about buying more in order to create wealth, please, please, please stop, because you need to have a certain amount of liquidity in case there is a whipsaw reaction and the market turns again. So if you look at what's happened over the last 3 or 4 days, the increase that we had there in GameStop has totally reversed. And in that reverse, all those people who bought up that cycle are now sitting with positions that are underwater. and they're
Wow.
losing money. So now you say, well, the game is totally unfair. It's not
Hey,
precisely
Vicki,
what I call unfair. Yeah.
let's use this. The game has stopped.
The game has stopped.
And by the way,
George,
Vicki,
something else. Yeah,
listen,
I got you.
we out of time, but if there's another point you want to make, but we are out of time.
Well, yeah, the point is this. This should not be treated as a game. You really have to understand what's going on, and you really have to have the liquidity in order to make this work for you. Don't put your pension fund in a process like this. Bottom line, don't put the money that's really important to you in a process like this. You will get hurt. Okay, George, I'm going to say this quickly. February 28th, go on to cnyjazz.org, a full lineup of everything that's happening and how you can get your own private code to the Black History Month Jazz Cabaret sponsored by Brackens Financial Solutions Network in conjunction with the Central New York Jazz and Arts Foundation. It's incredible. We not only are having Eric Darius perform on a closed program, and this is not a Zoom call, by the way. Understand, this is a high-tech production that's coming out of a music studio from Los Angeles here, specifically for the attendees to this event. Along with, we built in food options, because we always had this buffet. So we have food options, 3 or 4 restaurants here in town who have said they will make sure that they're open that night and have delivery available at a discounted rate. Go on to the cnyjazz.org site and purchase your ticket today. If you need to reach me, area code 315-930-4499. Look forward to hearing from everyone. Follow us on Facebook. Subscribe to us on YouTube and Twitter. George, our plate is full.
All right, thank you very much. Vicki Brackens is the president of Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC, America's Money Maven.